Wall Street's biggest players are quietly buying up the crypto supply behind closed doors. While small investors watch the trading charts, trillions of dollars are moving through institutional OTC desks and dark pools. Those are structures designed to source and execute trades in full confidentiality. By the time the trades hit the market, the move is done. Today I want to share with you how large capital pools are chasing the trillion-dollar land grab, who is doing it, why they will never sell, and what that means for every other investor in the market. Let's start from the mechanics. This chart shows you what Bitcoin costs. It does not show you how it has been acquired and what supply is left available. While you're fighting for a better price on an exchange, Wall Street is using a private door to buy millions without moving the price a single cent. That door is called an OTC desk, an over-the-counter broker. It works on private negotiation at a fixed price. There is no public order book, the trade happens and nobody sees it. These are the private doors. Kraken, Coinbase Prime, and a handful of specialist desks process billions of dollars of Bitcoin every week away from any public exchange. Coinbase Prime executed Strategy's entire Bitcoin purchase without moving the market. In addition to OTC desks, dark pools are emerging as a reserve of crypto holdings available for trades. In traditional finance, dark pools are private exchanges where institutional investors trade large blocks of securities without exposing their intentions to the public. As the blockchain asset class matures, this concept is now migrating on-chain. Now we know how they're buying. The most important question, though, is who they are, because the answer determines whether that Bitcoin will ever come back to the market. Three distinct buyers. Corporate Treasury is a CFO solving a balance sheet problem. Sovereign Wealth Fund is a government solving a national reserve problem. A family office is a dynasty solving a generational wealth problem. Each has a completely different holding strategy. Let's go through them. A CFO looks at a balance sheet with cash and short-term bonds and sees the danger of inflation eroding purchasing power. Bitcoin, with its fixed supply and liquidity, is seen as a hedge against dollar rebasement and a store of value. Some other corporates make buying and holding crypto their core value proposition. The company Strategy now holds over 800,000 Bitcoin, acquired for over $60 billion. That is nearly 4% of all Bitcoin that will ever exist on a single corporate balance sheet. Strategy used Coinbase Prime OTC desk to build this position, paying below market price and accumulating the position over months of undisclosed trades. If the corporate CFO is solving a 5-year balance sheet problem, the Sovereign Wealth Fund is solving a 50-year strategic one. This is where buying crypto moves from being a trade to being a government reserve. A Sovereign Wealth Fund is a national reserve vehicle funded by oil reserves or trade surplus, with a mandate to preserve purchasing powers across political cycles, economic cycles, and generations. Norway's sovereign wealth fund that manages $1.7 trillion and increased its indirect Bitcoin exposure by nearly 200% in a single year through equity stakes in Bitcoin treasury companies, including Strategy, Marathon Digital, and Coinbase. Abu Dhabi's state-owned Mubadala investment company grew its BlackRock Bitcoin ETF position by 46% in a single quarter, reaching $630 million and taking advantage of low prices of the bear market. Sovereign funds appreciate Bitcoin not just as a store of value, but as operationally superior collateral. Traditional collateral carries T+2 settlement risk, 2 business days of counterparty exposure on every trade. Bitcoin eliminates that. It trades 24 hours a day, 7 days a week. Price is continuously marked to market. Settlement is near instant, on-chain, and through smart contracts, collateral obligations can execute automatically. This removes the human intermediary and the counterparty risk, which are critical aspects. Significant sovereign wealth position changes require major committee reviews and pivot of investment strategies. Let me tell you something, that Bitcoin does not come back to the market at the next board meeting. While sovereign funds buy to build national reserves, family offices act on long-term conviction. For these players, Bitcoin is not about outperforming the S&P 500. It is about systemic insurance. And if you're managing your own portfolio for the next 20 years, this is the framework you need to understand. A family office is the private investment structure built around a single or multiple ultra-high net worth families, typically managing $100 million to billions. Their mandate is to transfer real wealth intact across 2 to 3 generations, protecting capital from inflation, bear markets, bank failures. A Bank of New York global study of 282 single-family offices reported that 74% have invested in or are actively exploring Bitcoin, a 21% increase in just 12 months. The typical allocation is 1 to 5% of total assets. And here is what the allocation actually represents. The 1 to 5% is not a growth bet. For a family office managing generational wealth, that allocation is systemic insurance. Family offices are governed by a family investment charter, a multi-generational governance document. This is not a trading position, it is a fundamental part of an estate plan. Now, if you're watching this as a professional in your 40s or 50s, you are already thinking like a family office. You are in capital growth and preservation mode. The question is not whether to chase the next 10 times. The question is, how do I ensure that what I have built survives the next 30 years? The family office framework, systemic insurance, fixed supply, generational governance is the answer the world's most sophisticated wealth managers ever arrived at. That framework is available to you too. Before we continue, if you're finding this analysis helpful, hit subscribe. I post weekly crypto analysis through a traditional finance framework. No hype, no paid promotions. Just fundamentals. The type of investors we have discussed, corporates, sovereign wealth funds, and family offices, are not engaged in speculative trading, but they tend to invest on conviction and hold assets as part of a formal strategic allocation. And if these three investor types are the ones taking the seats at the table, the question for you isn't just price, it's availability. We need to look at the terminal inventory, exactly how much Bitcoin is actually left for the rest of the world to buy. In traditional finance, when we analyze a scarce resource, we calculate the float, the amount of an asset actually available to be traded. Fidelity Digital Assets Research shows that long-term holders are reducing the stock of liquid Bitcoin available to purchase. The projection is that by 2032, 42% of total Bitcoin will be permanently illiquid, meaning not on the market. Bitwise projects that US ETFs alone could purchase more than 100% of all new Bitcoin issuance this year. The float is shrinking faster than a new supply can replenish it. In investment banking, we call this a supply squeeze. When an asset supply is absorbed faster than it can be produced and large holders are not selling, you don't need to predict the price. The maths do it for you. When this level of permanent capital saturates the Bitcoin market, inevitably overflows. In finance, capital always seeks the most efficient venue, and that creates an opportunity for altcoins. My view is that capital will flow into the assets that have acquired the same level of legitimacy. Let's see how it's going to work. Bitcoin dominance measures the market cap of Bitcoin relative to the whole digital asset market. It currently sits at around 60%, but historically it came down below 40%. Investment rotated into Ethereum and other assets. Institutional capital does not chase meme coins. It rotates into assets with regulatory clarity, proven utility, and institutional grade infrastructure. For example, Ethereum has a large spot ETF position. Solana has superior technology for financial infrastructure. XRP has obtain regulatory clarity. These are the coins that pass the filter, the ones positioned for the rotation when Bitcoin dominance breaks below 50%. If a protocol does not have institutional grade acceptance, the institutional money won't touch it. As an investment banker, I want to present both cases, and these are my bearish themes. First, policy reversal. We saw that in the US, Clarity Act has faced hurdles. Any legislation that supports crypto adoption may be reversed in a future administration, and tax levies may appear to penalize digital assets. Second is concentration risk. When one player dominates a large chunk of Bitcoin ETF flows, their internal decisions move the entire market. A single large redemption can trigger cascading outflows without any warnings for retail investors. And third, macro conditions. Bitcoin has increasingly displayed positive correlation between 0.3 and 0.5% with global stock markets. A large market correction would surely spill into crypto and cause an extended crypto winter. Even if the institutional thesis is intact, timing is not immune to microcycles. Here is my verdict. Wall Street is not coming for Bitcoin. Wall Street is already here, using deal structures specifically designed for large investors and global clients. Corporate treasuries, sovereign wealth funds, and family offices are different types of permanent capital, absorbing the free float and reducing the inventory available to all investors. I expect to see signs of Bitcoin dominance further decreasing and a more formal rotation trigger for altcoins. In the next videos, I will present to you more crypto analysis and frameworks, all of which seen through traditional finance lenses. Hit subscribe so you don't miss the frameworks. Before I leave, there's a quick disclaimer for you. This video is for educational purposes only. not financial advice. All investments carry risk. Please consult a qualified financial advisor. Take care and see you in the next video.